Hello everyone, welcome to today's US Open live webinar. It is 10 minutes before Wall Street opens as always. It is Thursday, October 19th. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Netflix posted strong results overnight and was rising substantially in pre-market as we head to the open of Wall Street, whereas Tesla disappointed and its stock drops. Meanwhile, US yields continue to rise and jobless claims fell significantly, but USD is subdued today. Markets also continue to monitor the situation in the Middle East, but oil prices slide today as the US lifted sanctions against Venezuela. Yesterday, meanwhile, we got inflation data from the UK, which showed stubbornness and keep further tightening from the Bank of England in play. And we also have key events coming up, highlighted by Mr. Powell's speech later today. That's what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers carefully. And bear in mind that anything discussed in this session does not constitute investment advice and should not be taken as such. Let's give it a few more seconds and then we will begin. Okay, let's get the ball rolling because we have a packed session today, lots of things to talk about. We are going to start as always with a Euro USD. We're gonna move to GBP USD and talk about UK inflation and its monetary policy implications. Then we will transition to USOIL and the decision by the US to lift sanctions against Venezuela to sort of ease price pressures, and then move onto the Nasdaq. We're gonna also discuss the earnings from Tesla and Netflix and round things off with what's ahead. The US dollar eases today despite the rising yields. The 10-year yield extended its gains. It's at the highest since 2007. And we also had strong, significant drop in jobless claims. This should lift the US dollar, but it's cautious actually today. Perhaps because some pressure is because although yields rise, they failed to clear the 5% mark, so maybe that's why. And there was also, of course, a continuation in this mostly soft rhetoric from Fed officials. Mr. Waller yesterday in one of the latest said that he believes that policymakers can wait and watch and see how the economy evolves before they make any moves on rates. As such, Euro USD finds support today, as you can see, and maintains its hopes for tackling the key, the critical technical level at 1.063, 1.0642. Daily closes above it, as we have said again, would open the door to the next confluence of resistances at 1.07563. Of course, as we have said, again, the upside is unfriendly. There are key hurdles to clear, and the pair does not inspire confidence for a sustained recovery, for a meaningful recovery under the current technical and fundamental conditions. And furthermore, we had a significant moderation in Eurozone inflation, as yesterday's data showed. And the bearish bias is intact below the 200-period EMA, the black line, and there is risk for new 2023 lows, but further losses towards and beyond 1.0337 have a higher degree of difficulty. Let's now talk about UK inflation, which proved sticky in September, as yesterday's data showed. Headline CPI stayed at 6%, and the core is only marginally at 6.1%. This print comes less than a month after the Bank of England had paused its tightening cycle following 14 straight hikes, emboldened by the then sharp inflation deceleration in August. They have maintained a non-committal stance that makes the policy outlook uncertain, but this CPI print keeps more hikes on the table. Of course, it remains to be seen whether officials will be able to stay on the sidelines again at the beginning of November, which is their next policy meeting. The pound reacted higher initially yesterday on the news, but USD strength prevailed. The pair remains in a precarious spot and vulnerable to 1.200. But it may be early to talk about further weakness towards the 2023 low at 1.1801. Similarly, here you can see that it tries to find some reprieve and has the technical room to push towards 1.23 and the black line, which is the 200-period EMA. But you can see that the upside is similar to what we saw in the euro dollar. It's an unfriendly region. And let's pivot to US oil. The rally cools today as the United States lifted sanctions on Venezuelan oil for 6 months, and it's a temporary lift, and faces pressure, as you can see on the chart. It's on negative territory. As such, further decline towards this month's lows at around 81.5 would not be surprising, but we definitely struggle to see sustained weakness under current conditions, technically and fundamentally here too. The situation in the Middle East seems to be escalating after the Gaza hospital bombing that killed hundreds. Israel, of course, has denied any involvement, points the finger elsewhere, but in any case, the situation, regardless of who did it, has created risk of a spillover of the crisis. In any case, above the 200-period EMA, which US oil tries to hold, the upside remains intact, the upside bias, and the road towards 95, 96 open, but I still remain cautious around this $100 narrative. But I would say the path of least resistance is higher. And with 1 minute to go before Wall Street opens, let's head over to the Nasdaq. Not much has changed since our previous session. It's a bit of because the mixed tech earnings from Netflix and Tesla, and we're going to talk about that right after, cannot lift it meaningfully higher. 10-year yields, as we said, continue to rise to the highest since 2007 and pose headwinds below the 200 period EMA, the black line. Again, it is vulnerable to further pressure towards 14,442, but it's the September low. But the downside seems well protected from that point onwards. However, the tech-heavy index shows resilience, helped of course by the soft Fed rhetoric, and still has the ability to push higher. On the other hand, we'll need a catalyst to break away from this range-bound movement that we see lately, and to challenge 15,946 resistance. Now let's talk about the Netflix result. You can find detailed analysis on the FXCM market analysis websites of your respective regions. Both those companies reported on Wednesday after Wall Street closed, and the results could not be more different, as the streamer impressed, and its stock benefits. As you can see, it opened much higher today, as you can already see on the chart, while Tesla disappointed and its stock falls. Now, Netflix registered further acceleration in subscriber growth, as its user base expanded by 8.76 million, and its revenue growth of 7.8%. It expects even faster pace in Q4 in the double digit. The streamer also announced a price hike in some of its tiers, but not the entry ad-supported plan. We have talked again about the technical landscape, both through the sessions and through our written content. It had a tough third quarter in FLX, and closed below the 38% Fibonacci, but now jumps because of the strong results above the 400 mark, and that can set it on a path towards 483.52. Now, in regards to Tesla, it was an opposite image, let's say, because the EV giant saw its revenue drop by around 6% sequentially. Operating margin also dropped substantially, and net income was the lowest in 2 years. We had warned about further pressure on profitability given the drop in deliveries and the lower asking prices. Mr. Musk stressed that Tesla has to make its cars more affordable. One way to do that, of course, is through price cuts, so this could continue, this strategy of slashing asking prices. The company also gave us an update on the Cybertruck with a delivery event scheduled for November 30, but the CEO tempered expectations during the earnings call, saying it will need a year to 18 months before this model can drive significant positive cash flow. Now, Mr. Musk continued to emphasize progress on artificial intelligence, and he said that this can make Tesla the most valuable company in the world. And let's break the Tesla chart over. Of course, Tesla is one of our top stocks to watch in Q4 in terms of artificial intelligence. So you can find that video for more on that. Now, on the technical front, you can see that it opens lower today and challenges again the 38.2% Fibonacci and moves below the EMA 200. Its previous visit a few days back, weeks back in mid-August, was short-lived. Above this technical region here, biases on the upside. Below it, daily close below it could shift, could lead to a bearish shift. Okay, and as we continue to see the Tesla chart, let's talk about what's ahead. Chair Powell speech expected later today. The Fed has adopted a higher for longer stance, and its projections imply another hike this year for the terminal rate to be reached. But we have recently seen a dovish divergence from some Fed voters. And Mr. Waller yesterday, we already talked about that, was one of the latest. So the question here is, will the Fed chair validate those remarks, or will he maintain a hawkish bias? And of course, that's just a couple of days ahead of the communication blackout period, which kicks in over the weekend. Tomorrow, we expect Japan CPI inflation. Ex-fresh food has eased from its January peak, but has stayed above the 2% target for 1.5 years, roughly. There are some headlines that maybe the BOJ will upgrade its projections. But in any case, from what we have seen so far is that they believe that sustainable and stable achievement of the 2% target has not yet come in sight, and thus requiring a continuation of monetary easing. They have hinted towards normalization, but they haven't provided any signs of imminent action. Now, next week starts with PMIs and more key releases during the second half, and it's also a big week for earnings, with big tech and auto giants dominating the earnings calendar. But we will have the chance to talk more about that on Tuesday's session at our usual time, 10 minutes Wall Street opens. That's it for me for today. Thank you for joining me.